Hi guys, it's your favourite YouTuber again, Dami Solari, and you're watching DS Learning Finance. Whoa. So many ratios to understand, guys, and you need to fully understand the meaning of them and the implications and what to look for when investing in a company to fully utilise them. With that said, I've had to split this into a series, guys, of understanding the power of the financial ratios. You're watching part 1 to it. You guys want to find out the important stuff? You know what to do. Keep watching. First type of ratio is called earnings per share. This tells you the profitability of the company per share. So this is calculated by the earnings of the company divided by the total number of shares at that given time. So it's basically telling you how profitable the company is. For a lower number of shares, is the company doing just as good as another one which has more shares, and vice versa? So ideally you want to aim for as high of an EPS as possible, earnings per share as possible, because it ultimately means your shares that you're buying will be fully utilized and therefore you'll be making an investment on it. The second type of ratio is called PE ratio. In a nutshell, it's the price per share. So how much did you buy of ABC stocks? How much did ABC stocks cost you per share divided by the earnings per share of the company? It's telling you how profitable the company is. So you want to aim within a PE ratio of roughly 15 to 25. Some of you guys are thinking, oh, why can't I aim for a PE ratio of less than 1? Because that means the company's more has a higher earning than the share price, which is obviously better because it means they're more profitable. Yes, that's true, but at the same time it's unrealistic. Those companies generally tend to be very unsteady and therefore unpredictable. With that said, you don't want to go too high as well. You don't want to go into like 40s and 50s because simply it's just not worthwhile investing in. So the PE ratio, as you can see, tells you the value of the company. Is the company overvalued? Is the company undervalued? And what you want to do is catch it when it's undervalued and then slowly progress. Obviously, after time of keeping your stocks and purchasing more stocks, and hopefully your company doing well, then you can sell your shares when the company is overvalued. Therefore, you make a profit on. So that's the whole thing with the PE ratio. It tells you whether a company is undervalued and overvalued, and basically tells you when to invest in a company. The third type of ratio is called debt to equity ratio. So just by looking at the equation, it's easy to tell that the lower the debt to equity ratio is, ideally the better it is. You would think, not necessarily, within reason I would say. So a debt to equity ratio of less than 1 is basically, may seem good to you in the sense of, yes, us shareholders can cover the company's liabilities, but on the flip side, that does seem quite bad because it means that the company is not investing in itself, it's not taking risks, it's not doing research. Yes, I understand that a lot of the risk that they may take may turn into losses, but if they are just there, basically just stagnant, then the company's definitely not going to grow. So if the company's not reinvesting in itself, if they're not taking out loans, taking out debts to obviously increase their revenue in the long run, then they're just going to be left like ugly ducklings in the pond, literally stagnant and still, while the rest of their competitors just pass them by. So you don't want a debt to equity ratio too low. With that said, you don't want a debt to equity ratio too high as well, because yes, that means the company's taking out too much debt as opposed to equity shareholders. You want to aim for a debt to equity ratio of 2. This is quite reasonable because it means that the company has the shareholders being able to provide half of the finance to fund their liabilities if worse comes to worse. Now there's also another type of ratio related to equity ratio. It's called the debt asset ratio. I know guys, there's a lot of ratios, but yeah, it's called a debt asset ratio, otherwise known as debt ratio for short. Basically, it's the total amount of debt that a company owes divided by the total assets that a company owes. So this includes short-term debts and long-term debts. So it could be a year from now, 10 years from now, the total amount of debt that a company possesses, that a company has to pay their debtors, divided by the total assets that they owned. Now, this does not include liabilities as opposed to the debt to equity ratio. It's just strictly debt. In conclusion, guys, all of these ratios are derived from the financials of the company, the balance sheet, the cash flow statements, and the income statements. All of this is derived from those figures, from those financial documents. So ultimately, if you understand those documents, you understand what's going on with the business. And with that said, guys, that's the end of this video. Part 2 is coming next week, you know it. But in the meantime, you know what to do. Like, subscribe, and share. LSS, DS, and then finance world.